These 8 states are quietly pulling as much as $3,000 from retirees every single year, and most seniors don't even realize they're affected. In 2026, the list actually got smaller. One state, West Virginia, officially removed its tax on Social Security benefits starting January 1st. That leaves 8 states still taking a portion from your benefit check before it ever reaches you. But here's the part no one really talks about. Even in states that recently eliminated the tax, some retirees are actually paying more this year than they did last year. Not less, more. That's because there's a separate rule written into federal law that stacks on top of every state rule. And when combined in the wrong location, it can quietly take between $1,000 and $3,000 a year out of a retiree's budget without ever appearing as a clear bill. Most retirees don't notice this charge because states don't label it as a Social Security tax. Instead, it's hidden inside the standard income tax return as a taxable portion of benefits. You only catch it if you sit down and calculate everything. And by the time you do, it's often too late to reverse the decision that pushed your income over the threshold. By the end of this video, you'll know exactly which 8 states are still on the list for 2026, how each one determines whether your benefits are taxed, the 2 separate income thresholds used by the federal government on top of state rules, the new deduction quietly introduced in 2025 that offsets part of the burden for those over 65, and the 5 strategies that can reduce or even eliminate this exposure before the next tax year ends. Mark here, with over a decade inside the financial system, watching retirees get hit by rules that were never properly explained. Today's rule is one of the worst because it's invisible. Most retirees living in these 8 states don't even realize their state taxes Social Security until the year they owe money. So the first step is simply knowing whether you're on the list. There are actually 2 completely different ways states can take money from your benefits. The first group is easier to understand. 4 of the 8 states apply a flat percentage to the portion of your Social Security that is already taxable at the federal level, regardless of how high or low your income is. Those 4 states are Colorado, Utah, Montana, and Minnesota. If you live in one of these states and any part of your Social Security is taxable federally, the state automatically takes a share. Colorado is the most common trap because it markets itself as retirement friendly. The state applies a flat 4.4% tax. Retirees age 65 and older can deduct the entire federally taxable portion of their Social Security, which sounds straightforward, but here's the catch. Retirees between ages 55 and 64 can only deduct up to $75,000 of retirement income if single or $95,000 if married filing jointly. That means early retirees collecting Social Security before age 65, especially those who claimed at 62 to bridge a gap, end up paying the full 4.4% on the taxable portion until they reach 65. For a couple receiving $30,000 annually in benefits, with 85% considered taxable, the Colorado tax before age 65 exceeds $1,000 per year. Most don't realize it until they file. Picture a Colorado couple in their early 60s. One spouse retired at 62 and began collecting Social Security. The other still works part-time to maintain health coverage until Medicare begins. Their combined income ends up slightly above the $75,000 threshold because of the working spouse's wages. As a result, the full 4.4% tax applies to the taxable portion of Social Security. Over the 3-year gap before turning 65, they pay more than $3,000 in state tax on benefits that would have been fully exempt with better timing. That money is gone for good. It doesn't come back once they turn 65. It's simply the cost of claiming early under Colorado's rules. Next is Utah. Utah applies a flat 4.5% income tax. There is a credit for Social Security benefits, but it phases out as income increases. Full exemption only applies if adjusted gross income is below $54,000 for singles or $90,000 for couples. So a retiree in Utah with income from a pension, part-time work, and required minimum distributions that pushes them above the limit loses the credit entirely. For a couple just over $90,000, that can mean up to $1,400 per year in state tax on benefits already taxed federally at up to 85%. Montana taxes Social Security similarly to the federal government, which sounds simple until you realize their income thresholds haven't been updated in years. The base amount is just $32,000 for couples or $25,000 for singles. Because these limits were set decades ago and never adjusted for inflation, nearly every retiree with any outside income ends up having up to 50% of their benefits included in state taxes. Montana's rate can go as high as 5.65%. For a couple receiving $28,000 in benefits, this can mean about $800 annually in state tax. Minnesota is the fourth flat tax state and also the most complicated. The state offers a subtraction that fully exempts Social Security for couples with adjusted gross income under $18,320 or singles under $84,190. Below those levels, no tax is owed. Above them, the subtraction phases out quickly and taxes rise sharply. About 29% of Minnesota beneficiaries still pay state tax on their benefits, roughly 1 in 3 retirees. For those in the phase-out range, the average annual impact falls between $1,200 and $2,200. So if you live in Colorado, Utah, Montana, or Minnesota and your income exceeds those limits, the state is taking money from your Social Security every year, even if you never see it directly. The second group of states works differently. This is where timing traps come into play. Connecticut, New Mexico, Rhode Island, and Vermont don't use flat rates. Instead, they rely on income thresholds. If your income stays below a certain level, your benefits aren't taxed. But if you cross that line, even by $1, the taxable portion suddenly applies. The problem is that retirees often cross these thresholds not from regular income, but from one-time events like a Roth conversion, a large required minimum distribution, or selling a property. Connecticut starts taxing at $75,000 for singles and $100,000 for couples. Above that, up to 25% of Social Security becomes taxable at the state level. New Mexico allows full deductions under $100,000 for singles and $150,000 for couples. But once you go over, the deduction disappears completely. There's no gradual phase out, just a cliff. Rhode Island bases its rule partly on age. Only retirees who've reached full retirement age and stay under income limits qualify for exemption. Early claimers are taxed regardless of income for several years. Vermont exempts benefits under $70,000 for couples and $55,000 for singles. Above that, a phase-out applies, and eventually the full taxable portion is taxed at rates up to 8.75%. Now here's what surprises most retirees. Even if you live in a state that doesn't tax Social Security, the federal government still does. Federal law allows up to 85% of your benefits to be taxed based on income thresholds that haven't changed since 1983. Those thresholds are $25,000 for singles and $32,000 for couples. Above that, up to 50% becomes taxable. Above $34,000 single or $44,000 joint, up to 85% becomes taxable. Because these limits never adjusted for inflation, nearly every retiree with additional income falls into the 85% category today. When you combine federal and state taxes, the impact grows significantly. In some cases, retirees can lose over $8,000 annually between the two. Congress did introduce one relief measure in 2025 called the senior deduction. It adds a $6,000 deduction for those 65 and older, or $12,000 for couples, but it phases out at higher incomes and only applies at the federal level, not state taxes. That means retirees in these 8 states still face the full state burden. The good news is there are 5 proven strategies to reduce or eliminate this exposure. First, use low-income years to make major financial moves like Roth conversions. Second, review your state residency carefully if you're considering relocation. Third, time Roth conversions strategically to avoid crossing thresholds unnecessarily. Fourth, use qualified charitable distributions to reduce taxable income. Fifth, Carefully plan required minimum distributions to avoid stacking income into a single year. All of these strategies are legal and commonly used, but they must be done before December 31st. Once the year ends, most options disappear. The 8 states still taxing Social Security in 2026 are Colorado, Utah, Montana, Minnesota, Connecticut, New Mexico, Rhode Island, and Vermont. West Virginia has officially removed itself from the list. The federal government still taxes up to 85% of benefits. The new deduction helps, but only partially. And without proper planning, retirees can lose $1,000 to $3,000 every single year for the rest of their lives. Your next step is simple. Review your latest tax return and check whether any of your Social Security benefits were taxed. If they were, and you live in one of these states, you're affected. Then speak with a qualified tax professional and plan ahead before the year ends.